Thanks, Brian, for the introduction. I think you guys can still see all my screen currently. Hold on. Okay. Can you guys see this?
Yes, we can see it, Ravi.
Okay, perfect. All right. So look, picking up from Brian's introduction, I think he hit the nail on the head. We are the only independent mortgage brokerage company that is authorized and licensed in this part of the world. So simply put, there are multiple brokers based in Australia. We're the only one we feel that is based in Southeast Asia that has made our focus overseas borrowers. Why the difference? Non-resident borrowers in Australia probably have difficulty obtaining finance when it comes to overseas income. The bankers in Australia probably do not understand how to calculate their income and help them qualify for loans in Australia. So sometimes you've got high net worth individuals that we deal with in Singapore that need a more personalized service and need some credit advice up front before they show their documents to any lender. As we go through the presentation, you'll be able to see some of the niches and in our service that maybe you probably don't know that is available, but then is robustly available to non-residents and something that you can tap into for your other clients. Okay, so I'll start off with this quote: "Risk comes from not knowing what you're doing." Generally, in my experience, for the last 5 or 6 years, living in Southeast Asia and working in project marketing, specializing in off-plan developments and financing them at settlement, I've realized that when in Southeast Asia, people worry about the property first, buy the property, and then they worry about the finance later. Unfortunately, in Australia, obviously, sometimes when you buy off the plan, it's 1 or 2 years away. So in the meantime, there's no progressive payment or anything, so there's no loan approval up front. It's something that I want to highlight. There's no approval that comes up at the beginning, as opposed to Singapore property or other parts in the world where when you purchase the property, you take the loan, you get the approval, and you start making your repayments. In Australia, it works differently. It's build and sell. And in this instance, a lot of people go into buying the property under the assumption that because they can borrow in Singapore, they can borrow in Australia. Or they just took a loan in Singapore, they had no problems. So in that sense, they go in blindly, and sometimes if they don't get the right advice up front, it can lead to some issues when they actually have to pay for the property, which is at the very end. So I think a lot of this Brian would have went through just now in the introduction, which was very, very, very thorough. But to rehash on this, we can do some questions later. But basically, only one in Southeast Asia. We've been in the industry since 2008, and since 2017, we have made non-resident investors our focus. At the moment, we're roughly around 200 to 300 borrowers that we manage at any one time on an ongoing relationship. So not only do we help them write the loans, we help them restructure those loans. Sort of a banker for life, so to speak. So as long as the loan's been written by our company, we'll assist the client dealing with the bank, refinancing, restructuring, renegotiating interest rates, and also unlocking equity if they need it. Okay, so I've been in the actual industry, capital markets, for about 11 years. Also doing financial services at the same time, assisting project marketing companies throughout Southeast Asia and developers across Australia. I also consult to developers who want to start their own financing in-house sometimes, and also consult to some banks in Southeast Asia that want to start offering Australian property loans. So from there, that's a little bit of my background. Okay, our head office is in Melbourne, and I run the team out of both Malaysia and Melbourne. So we've got roughly about 7 to 11 people that are full-time working on non-resident investors or Southeast Asians borrowing in Australia. Okay, we are licensed, so this is very important. When I talk about we're licensed, anyone can talk about loans, right? But we're insured. Okay, simply put, if we say you're going to get the loan, you don't get the loan, our insurance will pay. Okay, we are professionally indemnified as financial advisors, and especially when it comes to credit policy, we are authorized by the Australian government to give financial advice when it comes to certain types of transactions, similar to what your clients are probably going to be interested in. And that advice is sometimes crucial for non-resident borrowers when they want to know how much they can borrow before buying any property, or what if their documents qualify, or what they just basically what they need to know, where the secret sauce in the middle that can put all that together, the agent, the property, the settlement, the lawyers, and tie it all together with finance. So these are some of our lenders that we deal with on a daily basis. These are some of our partners that we work with. You may be familiar with some of these banks. Some of them are Australian, and we have a full suite of these. Are not all our lenders. We have about 22 on our panel, and some of them are Singapore based. Why I've put the Australian banks on there is if you've got any clients who are Australian PR, Australian expatriates, or have taken a loan from an Australian bank previously, we're able to refinance that if we need to, or give advice on those particular loans, even though we didn't write the loan in the first place, because we are authorized representatives of these lenders. We have individual accreditations. So talking about our services and I guess the 4 parts of our business, one of our focuses would be non-resident lending, like I said, specializing in the last 7 years, just focusing on overseas borrowers. We understand the currency, we understand CPF, we understand Singapore taxation. So we're able to give that advice very quickly. Sometimes in our business, especially when I was doing my financial services studies in Australia, my lecturer used to say that a quick no is almost as good as a very slow yes. So we're able to give that advice up front, and our specialty in non-residents sometimes is giving that advice very early on. So clearing all the ambiguity when it comes to can I borrow or not. And if every client feels that their situation is unique. So in that sense, you would need someone that specializes and understands intimately your client's financials, or probably does this on a daily basis, as opposed to someone who can just provide loans, so to speak. Yeah. Okay, so we do construction finance as well. So if your clients could buy let's just say a house and land package, if they want to do some development in Australia, if they want to buy a piece of land that wants to subdivide into 4 or 5 townhouses, we do that as well. So there's some commercial and construction financing that we've done in the past over the last couple of years for overseas borrowers. So if that's something that your clients may be interested, you can talk to me privately about this kind of finance. We do refinancing and equity release. The term refinancing in Australia, basically moving from one bank to another. Okay, that's what we call refinancing. Repricing is something else where we negotiate with the existing lender, but jumping from one bank to another for a better package. That's just basically what it means. Refinancing your loan from one bank A to bank B for a better package. Okay, equity release is something different. We can combine those two, but basically equity release means property has moved up in value. The client has bought it for 500,000. After 2 years, it's maybe gone up to 700,000. They will come back to the bank and say, look, Raveen, my property is now worth 700,000. Instead of selling the property and cashing out that 200K, I've come across another investment opportunity my agent has presented to me, but I don't want to come up with any money from Singapore. Can I take it from my property in Australia? Essentially, yes, you can. And that's what we do when it comes to equity release, taking out that equity and then using it for other investments. Okay, we actually, during COVID, we had a couple of clients from Singapore who needed to cash flow their businesses in Singapore, and they refinanced some equity from some of their Australian properties and took out about 200,000 just to keep their businesses afloat during COVID. So we've done that as well. If it's not just property related, we're still able to do it on a case-by-case basis. And then coming back to the beginning, giving that advice up front, we do financial consultations and pre-approvals. So if that's something if your clients are interested in, or sometimes you may present this product or Australia to them, they may turn around and say, look, it's very hard to get a loan. That's where we're perfectly situated to then jump into the conversation and really advise and set aside their biases and actually make some clarifications to them. Okay, so giving you a little bit of our track record and our volume of what we do at the moment, we've got written about $198 million worth of funds under management. That comes to about 400 borrowers, and if you count the amount of properties we've financed, it's about 216. Okay, and if you add the total value of our total asset pool that we've financed, all of our security value, today it's about 328 million. So we have a significant chunk, and these are just only our Southeast Asian clients that we've done. So you can see that there is a large volume of transactions of Southeast Asian borrowers purchasing in Australia, and that's the amount of property that they own only through our company. Yeah. So I'm going to come to how do mortgages work in Australia, just the basics. Yeah. So all the loans in Australia, if you're purchasing for investment, okay, a good broker should be able to do 30 years regardless of age. Okay, as long as it's for investment, we do not take age into account. We've got a case study on our website where we did a 70-year-old Malaysian businessman, got him an unconditional approval for 30 years. People may ask, sometimes they laugh like, oh, he's going to be 99 or 100 by the time that the loan expires. Is he going to live that long to pay off the property? Simply put, the banks look at Australian property differently, especially when it comes to investment. Okay, they know that the borrower is just sort of filling a hole in that transaction. At the end of the day, the rental pays for the loan anyway, and after about 5 years or 10 years, the loan on their books probably has a life cycle of maximum 5 to 10 years. Okay, after that, people refinance, they sell the property, the borrowers change, or they start the loan from zero again by taking out the equity and starting the tenure from zero again anyway. Or, my point is, properties don't reach the life cycle of 30 years. No one actually pays off the loan down to zero eventually, because there is no early repayment penalty and there's no partial repayment penalty in Australia. There's no lock-in period. So that creates a very robust refinance market with clients jumping from bank to bank without loyalty, and keeps brokers like us very busy refinancing those loans or jumping from bank to bank. We offer fixed and variable rates. So you've got fixed rates where you can choose to fix your rate for a certain period of time, not the full 30 years. But then you can also go variable rates, which are at the moment pegged to the RBA. The RBA, you can look it up on your phone. It's the Reserve Bank of Australia. It is similar to your SIBOR or LIBOR. It's a cash rate guide that the Australian banks rely on to determine the cost of funds. You've got repayment options where you can take a loan for interest only. Okay, so this is something new, I think, for Singaporeans. So every time I sit down with a client in Singapore that's about to settle on a property, when I quote interest only to them, they get very scared. They're not familiar with it. So basically for an investor purchasing a property in Australia, you can purchase a property and only have to pay the interest on the loan. Okay, the aim is to hold the property for as long as possible, for as little as possible, and during that period, you're still able to pay principal as and when you wish on an ad hoc basis, but it just lowers down the minimum monthly installment. Okay, so interest only is an option for investment property if you're an overseas purchaser. Before I go to the next slide, there's underneath interest only, there's a principal and interest, which would be a standard amortized loan that you would get in Singapore, 25 years, 30 years. The repayment schedule would be very similar. But I've also got offset account. An offset account, a lot of Singaporean clients as well are not familiar. So basically, it's an account's parallel to your actual loan account. Okay, like a savings account. Basically, once the loan's approved, we have opened two bank accounts for you. One is a savings account where you can transfer money in and out. The second one is your loan outstanding, which would, if you borrowed 500,000 after day one, you'd see two bank accounts, one with 0 and one with minus 499. Okay, that account with 0 is where you would deposit your funds every month to make your repayments, or you would channel your rental into from the actual property, right? So how an offset account works is that parallel account, or that sub account, would have an offset facility attached to it, where, let's just say in this example, let's just say borrower one wants to put $50,000 into their offset account. Okay, so the client puts their rental income into the offset account, like I said at the beginning. They deposit $50,000 of their own money, and their mortgage is $150,000. Okay, let's just say, for our argument's sake, in this scenario, client's taken a loan of $150,000. They put $50,000 of their own money into the loan. At the end of the month, the bank will calculate how much they've got in the offset account and offset that from their entire mortgage. Simply put, if they take a $150,000 loan, but the client puts in $150,000 of his own money into the savings account, which is the offset account, the bank will take the loan minus the offset account and charge interest on what the difference is. So in this scenario, if the client wants to put the full 150 in, he can do that, and at the end of the month, the bank will charge him 0 interest. That money is not locked. He can take it in and out of the bank account as and when he wishes, and when he pleases. He doesn't need anyone's permission. He can just do it from his phone, from internet banking. So he can move that money in and out to control his installment as and when they wish. So we've got a lot of Singaporean clients that have offset the entire mortgage, sometimes for the first 5 or 10 years, until they realize that it's not such a good idea in the long run. But from time to time during COVID, when interest rates were high, clients can put in maybe $50,000 or $20,000 and enjoy a lower installment for a certain period of time. Now, eligibility is a common question that we get asked with. Am I eligible? What do I need to do to qualify for an Australian loan if I buy an Australian property? Okay, so the basics are 18 years and above. They need good credit history in Australia. The property has to be larger than 40 square meters or less than 5 acres. Okay, any properties outside this spectrum could either come under a commercial lending arrangement, or they just need special permission. This probably doesn't matter for a lot of your borrowers, because they probably don't want to borrow the full maximum amount. But sometimes when the client's looking to exit their property and sell it, these rules apply both to non-residents and Australians. So it's important to know your end buyer and what their financial requirements are going to be. If your property is hard to get finance for, or can only get 70% or 50% because it's a specialist property that is outside this scope, then most probably when you sell, the next buyer is going to have some issues taking a loan, because in banks in Australia, simply put, they don't look so much on the borrower. They care more about the property, which is why they're giving 30 years. They know the property is going to be there for 30 years. They're just holding a charge over it. The borrower obviously makes the repayments, puts their name on the property, but then at the end of the day, the rental's coming in. Okay, so profiles, investor and owner-occupier. Why I make this difference is important. Yes, everyone who's purchasing a property can either be an owner-occupier, may buy it for friends and family, or their children may stay in there, etc., or they also be you can also be an investor. So what's the difference, right? Why do I make this this differential, right? Because if you're an investor in Australia, when it comes to qualifying for the loan, when you have to show income documents, we can use the potential rental income from the property to help qualify for the loan. That's why I make this differential. If the client is buying for investment and I need to see 5,000 Sing a month in income, right? But the client only earns 2,000 a month, but the property itself is potentially valued at, renting out at $3,000 a month. Okay, then I only need to see the 2,000, and we can still get the loan. So that's the one I want to make this point. If you're buying an investment property, in Australia, the proposed rental can be used as income, even though the client has not settled on the property or they don't own the property, or even they haven't even earned $1 of rental yet. We can still use that portion of the income. Okay, so what options are available? At the moment, our cheapest rates for domestic and Australian expatriates are around 6.4. They start from 6.4, and then for non-residents, they go slightly higher, up to 7% and mid-sevens at the moment. Really depending on self-employed borrowers as well. If they're self-employed, there may be a slight loading to that, depending if they're taking interest only or what their standard of documentation is. We're doing a Singaporean couple at the moment who has a business that has continuous losses for the past 3 or 4 years since COVID, and their profit is decreasing. So in those instances, we still can do the loan, maybe at a slightly higher interest rate, 0.5% above everyone else, where we don't show the company financials or the bank statements. Instead, we get their accountant to sign a letter saying that they understand that the company is on track to make profit. Those loans are seen as slightly riskier, but we don't say no. We can still do those loans to a point. Obviously, the interest rate's higher. Now, another development as of 2024, all overseas borrowers can borrow up to 85% of the property value. Okay, up to 85%. This is as of 2024. As of last year, it was 80% to the second half of last year. Before that, it was 75. When we first started in 2017, it was 60 to 65%. So simply put, the Australian banks and lenders in Australia, their appetite is growing, and they're getting more and more comfortable with Southeast Asian borrowers and overseas income. As overseas investors invest more in Australia, they're becoming more familiar, more comfortable, and as such, they're pushing the limits of what is possible for non-residents. And at the moment, we have a product, not all banks, but most of them have a product for non-residents that will go up to 85% of the property value. As I touched on earlier, interest only is another big point. They can take a loan. Let's simply put 85%, but they can pay interest only on the installment. That drops the installment in some cases by 1/3. Okay, simply put, it gives you a positive cash flow when it comes to your rental, and there's some significant surplus that stays in the residual bank account from month to month, so giving them a positive cash flow. So it really depends on how much what the interest rates are, how we structure the loan, but interest only is another favorable option for some investors that we recommend if they're not planning to pay off the property down to zero. Okay, so I touched on the rental income. Okay, Singaporeans, they have the unique ability to borrow from Singapore banks and from Australian banks. Okay, and Australian financial institutions. As an Australian myself, I even though, let's just say I become a PR of Singapore, work there, live there, if I'm buying a property in Australia, the Australian banks in Singapore are not allowed to lend to me, and none of the banks in Singapore are allowed to lend to me as an Australian citizen for Australian property. Don't ask me why. There is a treaty between both financial reserve banks, both the MAS and the RBA, that prevents us from circumventing that banking network in Australia as an Australian. Okay, but as a Singaporean citizen, you have the ability to choose from both jurisdictions. Okay, that's quite a unique situation. So you have more options than Australians sometimes. Okay, so a lot of clients ask, again, another common question is, how much can I borrow? A simple answer would be a clear income of 6,000 Sing would probably get you around $350,000. That seems to be the sweet spot with our clients. So obviously we've got clients that borrow 100,000. We've got clients that borrow in the millions, some sophisticated investors, but our average loan size is about between 350 to 500,000. So I think I picked that number as a sweet spot to advise a lot of overseas purchasers as to how much income we need to see in order to qualify for the loan in the first place. Required documents. I don't think I'll go too deeply into this, as I think the second speaker would be on track. We can have a private conversation about this if there's any clients here or your clients feel that they want to have an in-depth conversation about what documents are required. It's very basic. I think it would be the same for Singaporeans applying for a bank loan in Singapore. We just need CPF, ID, passports, pay slips, etc., bank statements. The documentation process again is quite straightforward. There are 8 steps that we take in order to qualify for the loan if we're doing a preliminary assessment. So the first 4 steps are simply put a pre-approval when it comes ready to draw down the loan, and the last 4 steps are in the midst of drawing down the loan would be to present those financials to a lender, get their agreement, negotiate the best rate, negotiate the best structure, and then get the lawyers involved to ratify those documents. Client signs the documents from Singapore. Thanks to the pandemic, everything can be done now from Singapore. The clients don't have to go to Australia to open a bank account. They can do everything on Zoom. As long as they can accept DHL to their house, we can courier documents, get 2 pieces of paper signed with an original signature, get them picked up the next day, do the verification of identity all via Zoom, get the solicitor to certify that ID by attending the Zoom meeting, and open the bank account in Australia and settle on the property. Okay. Coming to market opinion, we do a lot of loans, yeah. So simply put, we have a lot of data. We operate on more data than most agents. We use bank data because the bank requires us, when we submit a loan, to back that up with independent parties. One of those independent parties is a company called Heron Todd White. Okay, you can Google this from your phone. It's simply put herontoddwhite.com.au. And every month they release a market opinion. Okay, banks rely on this to give loans. If Heron Todd White says that your client's property is worth $1 million, even though your client on the contract paid $500,000, then we can go up to 85% of that million, even having your client only having to settle at $500,000. This is how powerful companies like Heron Todd White are when it comes to market opinion. Okay. And they release a property clock once every month, and taking into all of the hundreds of valuations that they do, they will put major cities based on their opinion and to see where they are on a property clock. So this is some good information for your clients. You can get this online. Every city on this list has had a significant change in the last month. Okay, so all the cities in blue have moved from where they were last month. Okay, so if you see how a clock works, peak of the market is 12 o'clock, 3 o'clock is a declining market. Bottom of the market would be 6 o'clock, 3 o'clock would be a rising market. So simply put, where's the best time to buy a property? A lot of people say 6 o'clock. I would say no, because you don't know how long it's going to be there. Just because it's at 6 o'clock, it doesn't mean it's going to be at 7 o'clock the next month. The best time would be to buy a property would be around 7 o'clock, 8 o'clock, or just before 9 o'clock. Okay. What we want to see is that Melbourne is listed as of last month at the start of recovery, which is on track for a growth spurt. When interest rates drop, we all agree that interest rates are at the moment globally at an all-time high. Melbourne's going to benefit from this. There's various number of factors. I think the developer's going to go into this, so I don't want to take too much steam away from them as to why Melbourne. But from a bank's point of view, this is the data we use, and that's why we're very gung-ho about Melbourne property at the moment. We can go up to 85%. It's actually probably easier to get finance for Melbourne property as opposed to all of these other major cities listed here currently. So it's some food for thought, and this is some data that you can share with your clients as well. Okay, I'm going to go into some of our case studies that show our track record. This is the one I think I spoke about earlier, where we did a 70-year-old Malaysian businessman for 30 years. How we did it, we go into details. It's on our website. Basically showing some EPF income, which is similar to your CPF. He was above 65. He was 70, and from 65 to 70, he never touched the money. He just left it in there. So it increased by 6% a year, and he had a few million ringgits in there. So that 60,000 a year that he earned as an ROI without touching the money, we were able to use as income, and we got him 30 years. So there are some tricky situations that we've done, and these are some of the ones that I like to highlight to people, as trophies. So another one was a Singaporean purchaser who purchased a property, a townhouse similar to the one that's actually being sold today. Not from this developer, from another developer, but in another state. During the pandemic, they bought, I think, around October, and they settled. Sorry, the contract price was around the 700,000 mark. If I go into details, okay. So in the case study says when they purchased a property at 740,000. Okay. But when we did the valuation, when the clients had to settle on the property, the valuation came in around the $900,000 mark. Okay, so they essentially earned they printed 220,000 over 12 months. Okay, so like I said, there's market value, there's contract price, developer price, there's also bank valuation. Clients bought at 740. Okay, they purchased at 740. When it came time to get the loan 1 month before settlement, the valuation came in at 960. Okay, and then the bank then allowed the clients to take a percentage of 70% of 960,000. The clients at the end, even though they budgeted for 20 or 25% to complete the purchase, they just came up with no money. They just paid the stamp duty of I think $40,000, and then they got the property without having to pay a cent at the end. So they were very happy. At the beginning, when I told them the valuation, they said, "Oh, typical Singaporean high net worth investors." They said, "Oh, it's just a paper gain, Raveen. I don't see the money in my bank account." But then when we did the valuation and we actually did the numbers with them, showed them that they actually over budgeted to complete the property, they understood that they actually made some money over 12 months. So in this instance, buying a townhouse, sometimes off the plan, you pay one price. But then when it comes to bank valuations, if you've got a good creative broker, we can use the valuations to our advantage to maximize, the investment potential. This is another scenario where we've done cross-collateralization, where we deal with a lot of Australian expatriates. One of them lives in Singapore. He bought 3 properties from one developer, and 3 in a row, we financed them all together in one loan. The total loan was 1.13, so each of them were around 500,000. And we did a large facility for him with ANZ Bank, where we structured a facility of 1.13. So cross-collateralization is actually possible for non-residents as well. This guy was Australian, but living in Singapore, working in the insurance field, quite senior guy, earning Singapore dollars. We were able to do this as well. I think that's it. Guys, if we've got any questions or anything like that, we'll hand over Brian. My contact details are here. I hope you guys were able to reap some benefit from my presentation. And if we want to have a deeper conversation or questions, we can do this. As and when you reach out to me directly, or I'm happy to meet with your clients if they've got any questions.
Great. Thank you so much again, Raveen. Right now, right, if you don't mind, right, could you just end your share screen, and we'll have Fiona come online to share her screen as well. And at the same time, Fiona, you might want to turn on your camera and your sound as well. There are some questions for you. If you could go to the webinar chat area, Raveen, there are 2 questions, one from Elaine and one from Lynette.
Yeah, there's one from in the Q&A part. Can Drew pay? Will Yara consider persons who are employed and who are also self-employed income for a loan? Yes. Through the presentation, I showed you there was 2 sets of documentation, one for salaried employee, one for self-employed. Most of our clients in this part of the world, Indonesia, Malaysia, are self-employed anyway. But yes, we do self-employed. It's bread and butter for us. Very straightforward. No difference for our team to do a salaried employee or a self-employed applicant or a business owner. Where do I go to the chat?
Okay, sorry. So I think if you can't go to the chat, I'll just read out very quickly for you. Elaine asked, does Yarra Capital covers clients from Indonesia apart from Malaysia and Singapore?
Yep, I just in my answer said, yep, we do Jakarta, We do Hong Kong. We're based in Southeast Asia, so that's why our staff, we have a team here of 7, based out of KL, and our head office is in Melbourne. So why I just focus on Southeast Asia is because our staff speak the local languages and we understand the documents. But yes, we've done people from the USA, India, UK, Hong Kong, China, our larger markets. But yeah, we do Jakarta, Indonesian, Surabaya as well. We've done them in the past. Another one, let me see. Will it matter if we hold properties in SG? No. Simply put, no. Sometimes they can be a benefit. If the clients have some rental income from a Singapore property, we can take that into account. If there is a loan against a Singapore property, if it's paid by CPF, we can use the CPF statements to negate that from the actual calculation altogether. One of the reasons why Singaporeans borrow from Australia, even though the rates are higher, is because taking a loan in Australia does not affect their TDSR domestically. Okay, so that's something that you may want to run back to your clients. So there's also a benefit in Australia. Even though the rates are higher, people have more flexibility, but it also frees up their TDSR to make, capitalize on any opportunities that come up as and when they do, rather than having their income encumbered or anchored by some loan in Australia.
Thank you so much again,